Chat with Traders collaboration with Quantopian, episode 1. Okay, what's up, guys? If this is your first time listening to Chat with Traders podcast, my name is Aaron Fifield, so welcome and big thanks for tuning in. What you're listening to right now is not a regular episode. This is a special 6-part mini-series in collaboration with Quantopian. For those unfamiliar with Quantopian, Quantopian is a crowdsourced investment firm who provide pretty much anyone with an internet connection to data, a research environment, and a development platform to write their own algorithmic strategies. Select authors then may also license their strategies to Quantopian and get paid based on performance. Now, the overarching theme for this mini-series is a look into the workflow of a professional quant trading firm. I will say I would consider some of the topics discussed to be quite advanced, but if you're into this sort of thing, I think you'll really enjoy it. If not, then that's also totally fine, but I feel like this first episode at least has relevance to traders and investors of all styles. Because this episode, to kick things off, is titled You Don't Know How Wrong You Are. And we specifically discuss numerous biases and the many ways that you can actually be wrong without knowing it. Anyway, I want to keep this intro short and sweet because you'll hear more about what to expect from this podcast series very soon. And I still want to mention a couple things that are important to address. So first thing, to find any of the links and resources mentioned throughout this series, you can go to quantopian.com/chatwithtraders to find everything there all in one place. I'll also have the same on the Chat with Traders website, so whatever is easiest for you. Second, like I said, after this first episode, some of the topics get a little complex at times. So if you want to ask something, you can go to quantopian.com/questions and submit your questions there. That way we can collect them all in one place and we will do our very best to answer as many as possible on the 6th episode, which is actually dedicated to Q&A. And thirdly, this series is sponsored by DataCamp. So if you're keen to learn a programming language or further develop your programming skills, I really encourage you to check out datacamp.com. I've done a bunch of their Python online courses and they're brilliant. They also have many courses teaching R, all of which are centered around data science, stats, and finance. So visit datacamp.com and create a free account to get started. Just to repeat, that's datacamp.com. Check them out. Now, without any further ado, please welcome Delaney from the academic arm of Quantopian. Let's get into it. All right, so Delaney, what's up, buddy? How you doing?
Not too much. I mean, I say that semi-dishonestly because things are, as usual, incredibly busy here, but nothing too much this evening. I've just got this and then I'm heading home.
Good stuff. Yeah. I can imagine. You've got QuantCon coming up too, so I imagine that's just amplified things.
Yes. Well, thank you for giving me the opportunity to right off the bat start pitching this. But yeah, we have a QuantCon Singapore coming up. It's the first time we've done it not in New York City. So we're excited about that. It's going to be in November, I think on the 10th or 11th, where there's a few days of events, but the URL is quantcon.sg in case anybody wants to check it out.
Good stuff. Yeah, I'm really keen to make it along. I don't know if I'll make it out there to the Singapore event, but if not, definitely the next New York one or something. I'm really keen to make it along. But anyway, man, I'm really excited to be doing this. So just to set the scene here, give us a rundown on who you are, your background, and tell us a little bit about Quantopian too.
Sure. So I'm Delaney. My last name is long and complicated. So it's out there on the internet. You can find it if you want to. Mostly I just go by Delaney. My background personally is in computer science, statistics, and math, kind of, at the intersection of all those three. And I joined Quantopian right out of school, actually, and I currently run the academic arm of the business, namely kind of what Quantopian does is we try to democratize quantitative finance. Quantitative finance is one of the fields in which the barriers to entry are just amazingly high. I think that some of them are so high that you don't even know how high they are. A lot of people, kind of will sit there and they'll say, oh, well, I have this great idea for how I could trade stocks, but there's just no sense of the path that you would go through to actually get that from idea into real implementation. So what Quantopian does is we try to provide as many of the tools and data sets that banks and hedge funds would have access to as possible, and provide them to everybody in the world, regardless of background or geography, and make it so that anybody has a shot to actually try to implement some of these ideas. Personally, I actually didn't know much finance before starting at Quantopian. My background, again, is in kind of computer science and stats. And I was so fascinated by what you could do with this stuff when I joined Quantopian that helped me realize that a lot of people do come to our platform to learn. And almost accidentally, I ran into a professor at Harvard. Actually got introduced to him by someone else who was taking his course, but I ran into him and basically discovered that he was using one of the same technologies that Quantopian uses internally to teach his course, namely these Jupyter notebooks. And they're such a powerful teaching tool. And what we said is, hey, well, why don't we use the same technology and try to teach quantitative finance to our users? Because, it's one thing if you have a great idea already and you're educated, but another barrier to entry is that nearly nowhere teaches quantitative finance. And since we want people to be, writing great strategies on our platform, we want people to be educated in doing that. So we've actually created through the process of working with a lot of professors at schools, including Harvard, Princeton, MIT Sloan specifically, Cornell, and many others that I don't have time to name. We developed the Quantopian lecture series, and that's where honestly I think a lot of content that we discuss over the next podcast is going to be drawn from. The lecture series are kind of designed to bring you from kind of knowing nothing about quantitative finance, but knowing a little math and a little programming, to really actually being able to compete with a quant in industry. And again, the goal of this is Quantopian's primary business model is to allocate money to the best ideas that are produced on the platform. And so we actually recently had some big news in which we entered into an agreement with Point72, in which they would give us, through a separately managed account, access to up to $250 million, subject to some constraints, to allocate out to our users' algorithms. And so now the idea is that we're trying to grow the size of allocations that we can make to algorithms on our website, and pay the users a percentage of profits that they make on the algorithm. So that's our main business model, is doing a profit sharing on algorithms that are sourced from our community. And kind of our dream user, our dream use case, is someone who comes from a background or region where they traditionally would just not have access to quantitative finance. They just wouldn't be able to do this, but through Quantopian are able to kind of, work hard, be smart, design a really good strategy, and actually get an allocation and make kind of on the order of the same amount of money that a professional quant would for doing the same work. So our goal is really to make it way more meritocratic than it currently is, and try to flatten out the playing field within quant finance.
Yeah, right. Now, just to pick up on a few things you said there, right back at the very beginning, you mentioned that the barriers to entry to becoming a quant are very high in most cases. Why are these barriers to entry so high? Is it the knowledge that's necessary? Is it the expensive data that's required? Is it the tools? Is it a mixture of everything? Why are the barriers so high and unattainable for many?
I think it's an all of the above circumstance. there's a lot of industry forces in finance which push towards secrecy and push towards not sharing what you have in any way. And if you look at the way that traditional finance firms have operated, they've operated in this way that like all intellectual property that is generated at that firm belongs to the firm. And it is incredibly rare for a firm to open up that intellectual property in any way. That is kind of a firm's lifeblood in many cases. And in the traditional business model, your activities are highly dependent on your ideas being new and your ideas being unique and that nobody else can figure them out. What that's led to is this circumstance in which not only in many cases is the academic field kind of far behind industry practitioners or just kind of going off in another direction that's not really related, but it's really, you just don't even know what has to get done. Things that would be kind of absolutely essential to a quant workflow. And as an example, I'd say like strategy capacity analysis, in that every trading strategy, has a minimum and maximum capacity that you can put through it. And quants do all sorts of analyses on that capacity to kind of figure out how much they should be allocating to each strategy in their portfolio and how they should adjust that over time and things like that. If, you're not already in that community, you just might not even have any idea have to be done. And there's so many sticking points that you can get stuck on when you're trying to do this on your own.
Yeah, so you brought up the fact of, there's a lot of secrecy that surrounds this. A firm does need to be somewhat secretive about their operations, though, don't they, to, be viable and stay in the game, essentially. Is that the case? Like, that level of secrecy is necessary?
So, I mean, if you make the argument that if assigning secrecy some kind of linear score between 0 and 100, and you make the argument that some level of secrecy is necessary, I would say yes. But where it falls in there is highly dependent on the business model of the firm, lots of other factors. I mean, as an example, one of the first things that Quantopian did is that we actually open sourced pretty much most or all of our code base. Not all, because we still had some proprietary code, but kind of most of our code base. And there may have been some time in the history of the business, I'm not sure, but there may have been some time in the history of the business in which all of our code base was open sourced. But we have a GitHub page. For those of you who are technical, you'll know what that means. For those of you who aren't, GitHub is just basically a service that companies use to store all their code that they've written, and you can make it open and freely available or closed and private. And we've made our backtester code, many of our libraries, just open and freely available. And that was something we did right off the bat. And the hypothesis was that open source code, you can have thousands of eyes on that piece of code and thousands of people looking at that code and finding bugs and making it better. And that's what we observed. We have, I don't even know how many views we've had on the Zipline, which is our back tester, our Zipline code base. And as a result, 4 years times, thousands of eyes looking at that code have produced so many bugs. So many bug reports have come out of, having that thing be freely and available and open. And I just can't imagine that a system that's written internally at a hedge fund and maintained by 5 engineers who look at it maybe, 8 hours a day each. I just can't imagine that system would be, in any way bug-free, because we have found so many bugs and we're still finding bugs in our system, after 4 years. And a bank that, has 2 years times 5 engineers looking at this thing, there's just no comparison.
Yeah, and that actually reminds me, on the Quantopian platform, users use Python as the programming language. Pandas, which is a Python library, if I understand correctly, that actually was originally developed by a man who worked within a hedge fund. Is that right?
Yeah, that's exactly right. I believe that's Wes McKinney you're talking about, if I'm not getting my people confused. And he was working at a hedge fund, and he was saying, well, Python's great for most of what we have to do, but there's some key things that are lacking. And so he said, well, why don't we just build those key things that are lacking? And these are kind of general basic tools that could benefit everybody. And I'm talking like people in finance, people in science, people in data science, all across the field. And so he built those tools. He made it open source. And as a result, Pandas has become this amazingly useful library, amazingly high quality library of code that's in use at so many funds all over the place. But, it's not a zero-sum game. Many people think of it as a zero-sum game, and some very specific parts of finance, if you zoom in close enough, are a zero-sum game. But in many ways, it's not a zero-sum game. And I think that that's kind of the failure of logic when people try to keep everything super secret all the time with no exception.
Okay. And just so there's no confusion here, would you mind explaining what a zero-sum game is?
That's a good point. So in economics, specifically kind of game theory, which is a branch of economics which deals with what decisions kind of should one make if you are trying to optimize some, utility, some objective function. You're saying, I want the most money or I want the most happiness. And you're trying to say, what decisions should you make in the presence of other people also playing the game often? It's not just you who's making these decisions. A zero-sum game refers to the case in which, the amount that you get and the amount that the other person or other players get have to add to the same thing. So, or have to add to a single quantity. So if you get more, it means someone else is getting less and vice versa. And that's the notion of a zero-sum game, is that you have to compete. And your competition and your success hurts others, and your failure benefits others. And that, again, it's true in some cases, but I really don't think it's nearly as common as people think it is. And in fact, one interesting thing that I could talk about for hours, and we don't have time to delve into, but many people learn basic game theory, what are known as equilibriums, which are kind of optimal strategies to take. Game theory equilibriums in school, especially if you'll take like kind of intro to economics courses. And those equilibriums kind of, in the same way that many physics theorems are proved in vacuums with no friction, those equilibriums are often proved mathematically, assuming many things. And these things include assumptions about like infinite computing power and perfect information, and never seeing this person again ever. Like these are called like single play games. And what computer scientists have done recently, they said that really does not sound like a reasonable set of assumptions to model the real world. And so they went back in and they've simulated these games in the presence of things like inefficient information transfer and inconsistent geographical distribution of people and all sorts of real world type conditions. And what they find is that whereas the very sanitary, I would argue unrealistic assumptions that are made in the original equilibrium proofs say that you're always better off kind of backstabbing people, and you're rarely good collaborating because the risk of someone else backstabbing you is too high. What's found is that when you re-simulate these games in the presence of real world conditions, oftentimes the reverse holds true, and cooperation and generally being nice tends to be kind of the optimal strategy in those cases.
Right. Okay.
Again, you can tell I'm a little. I could rant about this for a while because it's a sticking point for me that so many people go through these intro level courses and graduate into life thinking that screwing over other people is the best thing to do.
Okay, no, that's excellent. Now, just to pick up on something you brought up earlier, the $250 million from investment from Steve Cohen at Point72. What does this mean for users? Like, how is this actually going to change what's been happening sort of to date and moving forward once this investment sort of comes into play?
Sure. So, I mean, when we talk about anything to do with allocation, I just have to be, a little careful to make sure I don't say anything inaccurate because, we now have to start preparing to make sure that we're SEC compliant. They monitor any statements you will make about, investments. And in general, also, I like to be accurate about these things. But specifically, what this means is that Point 72 has agreed to make available to strategies on Quantopian up to $250 million. And that's going to be released over the course of a year. And there are certain, performance constraints that are going to have to be satisfied of the strategies that are picked. So it's not just like $250 million cash is getting delivered to anybody here. It's a well-reasoned deal. And what that means, though, is that previously, any allocations we were able to make to the strategies that we liked in the community tended to be very small. And they were basically kind of test allocations that we made off of our balance sheet. And now what we can finally do is start ramping up the size of allocations. And our goal is just to ramp the size of the allocations up higher and higher until the portfolios that are being managed by algorithms on Quantopian are kind of, as big as the portfolios that you would see at large financial institutions. And therefore, the people who wrote those algorithms can get paid on the same scale as people at the large financial institutions. And again, all of this is contingent on the strategy itself performing and Quantopian being able to secure capital to allocate out to algorithms, but that's our goal.
Yeah, no, that's really excellent. I mean, it's a huge win for you guys and obviously users of the platform too. So no, that's very cool. Now let's get into this. So, this is going to be the first episode of about 6. We're going to be doing another 4 episodes after this and then a Q&A at the end. What's the overarching theme of this series? Obviously, I've given a quick summary in the pre-recorded intro for this episode, but let's hear your take on what someone can expect to learn from listening to this series.
Sure. So, like I said, I think what we're trying to do here is we're trying to give more windows into the workflow of a professional quant or a professional quantitative finance firm. And some of this is really complicated stuff. I'm not going to sugarcoat it. Some of this is really hard stuff. And, you shouldn't expect to listen to a podcast and then, come out being able to do some kind of multivariate portfolio optimization analysis. But the goal is to kind of give you some holding points, give you some points, some skeleton, such that if you're interested in learning more, you kind of see some of the paths that you can take and point you to resources that you can use to start fleshing out your knowledge of the system. So again, like the goal is going to be to give you like a broad understanding of the lay of the land, and how quants work and how they're different from other traders and, what they do and what they don't do and what they worry about at night. But, not necessarily to be able to execute on any of the techniques that quants use, because honestly, that just requires more time to learn and more hands-on experience. One thing I will say just right off the bat is Quantopian, again, maintains this lecture series as a resource in addition to tutorials. And if you go to quantopian.com/learn, /learn will get you to a page where you can see tutorials if you just want to learn like how to get started on the platform. And also it will have a link to the lecture series where you can kind of get at more of this stuff in a much more hands-on way and actually play with the code and see what happens. In addition, we'll also try to set up a post on our blog so that we can kind of collect any of the resources and links that we talk about in these podcasts and make there be kind of a single source for people who want to just go there and look at it all at once. But that's something we'll be setting up at some point. And depending on the magic of free recording, it may or may not be available at the time you're listening to this podcast.
Yeah, we'll definitely sort something out in that regard. But anyway, the title of this episode, being the first episode, is "You Don't Know How Wrong You Are." Do you want to explain why we've titled it this?
Well, mostly because you don't know how wrong you are as the listener. And what I mean by that is one of the main differences, I would say, between a non-statistical and a statistical framework for thinking about the world is that a lot of statistics is an effort to quantify certainty and quantify uncertainty. and say, more so than make this choice or don't make this choice, really look at like the distribution of outcomes that you could have after making a choice or not making a choice, and try to estimate, hey, how certain am I that this choice is the right one? And how uncertain am I about, these choices that I'm making in general? And one of the things that, I find pops up quite consistently, especially when I talk to people who aren't from a quantitative background or kind of came from a non-quantitative background and transitioned into trying to do more quant stuff, is that something that you learn when you go through a kind of a classic statistics education at either undergrad or graduate program is you learn a lot of these biases and a lot of these things that can come back and bite you and just be completely invisible if you don't know about them. And one of the examples of this that I'll just go over briefly to start is something called multiple comparisons bias. And multiple comparisons bias refers to, it's a fancy name. It sounds complicated, but it refers to something that's pretty simple and kind of core. And in fact, I think everybody is vulnerable to this. Like even you making your life choices, about in general, regardless of what you're doing on a computer with finance, are vulnerable to this. And what multiple comparisons bias means is the following. So when you are looking at some event or some piece of data and you're trying to decide, whether some other thing is true, whether this data is significant, whether it reflects some overall trend, you do some kind of test. And that test might be a rigorous statistical test that you do on your computer. That test might be something just inside your head that you just say, yeah, I think this is significant. It could be either. It could be, you get into a room, a bunch of people talk about it, and then you all end up voting. These are all processes that transform that data into a yes/no decision. And whenever you have a test like this, if you make, each test is not perfect. So there's a chance that you get the wrong answer, right? And so let's look at the case in which, you're looking for examples of when to trade, and your data is flowing in, and you're looking for examples of when you should pull the trigger and actually place a position. And every time you look at that data, you're making a test. You're saying, should I trade or should I not trade? And there's a chance that there's a false positive, right? There's a chance that your test misfires and says, yes, you should trade, when really you shouldn't trade. And there was something, maybe the data just popped up, happened to look like the pattern you were looking for. You don't know. Something happened that caused it to be a false positive. And because your test is imperfect, the rate of false positives is not going to be zero. You're going to get some percentage of false positives. And as you make more and more tests, the overall number of false positives that you should expect to get gets higher. And what I mean by this is, let's say that the chance in every test that you get it wrong is 5%. Let's say the chance that you get a false positive is 5%. Well, if you run 1,000 tests, and that's not too unreasonable. You make thousands of decisions every day in your regular life. If you run 1,000 tests, you should expect to be wrong 50 of those times, because 5% of 1,000 is 50. And you should expect 50 false positives to pop up from a body of 1,000 tests. And the danger is, let's say that, you look at 1,000 different choices and you run your test on each. You will get 50 choices that look good just based on random chance, and some of them may be good and some of them may not be good, but you don't know. There's no way to distinguish between them just from the data you already have. So that's an example of a bias that a lot of people just don't even think about when they're going through their lives, when they're trading, whatever they're doing, but is really core to how a statistician thinks about the world. And is an example, I think, of people just not knowing how wrong they might be when they make decisions.
Right. So first thing I want to ask you based off of that is, what is a false positive? Maybe if you could just explain that for anyone listening who might be unsure.
Yeah, so I think a lot of the language in modern statistics came from how it was developed, and statistics was developed. There's a few major uses when it originally started, getting off the ground, and one of those was kind of medical. That's a natural source of you want to gather data about how sick people are and when they get sick, and let's say you're testing for a disease. You say someone is positive or negative for a disease, right? Let's say you're testing someone for the common cold, and you have some test which is based on the symptoms you see, and you write the symptoms down, and the computer, says, here's a score. And if the score is above something, you say, yes, they have a cold. If it's below something, you say, no, they don't. So, very common workflow. So in that case, a false positive would be when your test says, yes, they have a cold, but they don't actually have a cold. And the test saying yes was based on the data randomly lining up in such a way that it looked like they had a cold when actually they didn't. And this can happen equivalently if you're saying, I'm going to test to see if two stocks move in the same way, if they're correlated, and if you look at many, many pairs of stocks and try to say, give me some pairs that move in the same way so I can try to trade off of them. You're likely to come up with some pairs that just have happened to move similarly in the past, but that's not really indicative of any relationship. And it's because the data just happened to kind of line up in that way. Does that make sense?
It does, yeah. So, just going back to that example you gave there of the stocks, I think that's a really good one. So, you said it just so happened that the data happened to line up and these two stocks appeared that they were correlated. Why were they not correlated? Why was it a matter of fact that the data just happened to be that way, so that it looked correlated? Why were they not actually correlated? Does that make sense?
Yeah, absolutely. And I will say that as we talk about this, if anybody is interested in kind of seeing this in a more rigorous setting, we have a lecture called Pairs Trading in the lecture series. And that pairs trading lecture actually deals with a situation that's pretty similar to this. So if you want to actually muck around with real examples of this and see this all laid out in front of you, check out that lecture. But we'll start with a super simple example, right? Let's say that you represent stocks as up or down, right? You don't actually care about the magnitude of the returns, but you just have up or down at each minute or day, whatever your sample frequency is, right? And so let's say that you're looking at stocks and you have 1 minute worth of data. So again, super simple example, but we'll blow out from here, and hopefully it should become like apparent how this works. But let's say you have 1 minute's worth of data and stocks can go up or down, and you're looking at two stocks, right? What's the chance that they both end up moving in the same direction? And it's not a trick question. The answer is if one can go up and if one can go down, then it's a 50% chance that they line up. And you can do out the probabilities on a piece of paper if you want to convince yourself of this, but it's basically the same as flipping two coins and saying, what's the chance that they both come up the same? Not that they both come up heads, but what's the chance that they both come up the same? And so once you have that, fixed non-zero probability, well, let's say now you have 2 time points, and then you say, what's the chance that both stocks ended up, going in exactly the same over those 2 time points? And it's some probability, you can work it out, and then 3 time points and 4 time points, and you extend it all out, and so now it's like to 100 time points, right? So if you have 100 time points and you're representing the stocks as just up or down, the chance that, they're both have going to done the exact same thing on all of those time points is minuscule, right? And so if you looked at 2 stocks and you said, wow, they have been exactly the same over the last 100 samples, what a statistical test is really getting at is like, what is the likelihood that I would have observed this behavior if there's no underlying relationship? And the likelihood is super low. If they're just moving randomly, the chance that they would have lined up over 100 time points, super low. So in practice, though, they're not just moving up or down, and there's going to be some noise, right? And so what you do is you look at the two movements and you say, how similar are they, right? It's not just exact or not exact. It's like, how much of the time do they both move up? How much of the time do they both move down? And so the probability that two stocks line up in a way that's like enough to pass your test starts increasing. It's not like, something minuscule anymore. Now it's, let's say, it's 1% that the chance over 100 time points, they move similarly enough so that they pass your test. And so again, now we're at this point where it's 1%, and there's a 1% chance of a false positive in which you have two random stocks, but they have happened to move similarly enough over the last 100 time points that they pass your test of being related, even though they're not related. And so if you do 100 different tests on different pairs of stocks, you should expect to get one that pops out, one pair, because you should expect 1% of those tests to have false positives. So does that make sense in how, basically what you're looking at is the false positive rate is the rate at which two random things can line up enough to pass your test, but incorrectly. And different tests have different false positive rates. And in statistics, one of the really nice things is that you can calibrate the false positive rates, and you can kind of test what they are, and you can know about them. And one of the problems is that if you're just making these decisions in your head or in some other method, it's pretty much impossible, not impossible, but it's pretty close to impossible to really effectively calibrate those decisions and know what your false positive rate is.
Okay, so it really kind of comes back to the underlying relationship, and there actually being some meaning as to why those two stocks should be correlated or shouldn't be correlated, right?
Yeah, so statistics is really about testing for relationships in your data and just deciding what is the certainty I have that this relationship is real or that it's just kind of nonsense. And again, two things can line up so that they look like they're related and they're actually not. And that happens all the time, all the time. And a famous example of this is, I forget which website does this, but if you kind of Google weird correlations, you will find, I think, if I'm remembering correctly, you'll find websites that show you correlations on historical data. And so I just pulled one up, and this website is called Spurious. Spurious is the statistics word for kind of not really meaningful. Spurious correlations. And this they give you a random correlation. And so the random correlation they give you is if you look at the last 10 years in the US, and you sample let's look at the last 10 years in the US, and if you look at the number of people who drowned falling into a pool, and if you look at the number of films that Nicolas Cage appeared in, they line up pretty closely. Pretty closely, right? And you'd look at this and you'd be like, oh my goodness, there's likely a relationship there that I should look into this. But of course, what's happening is just that there's just so many things you can keep track of, that over that incredible universe of things, the chance that two of them don't happen to line up over some time period is super low. So what they're doing is they're just saying, because there's so many possible relationships, there's so many things I track, there's so many possible relationships, I just have to look at 1,000 relationships and one will pop up that looks pretty close. And that's this notion of kind of multiple comparisons bias.
Right. No, that's awesome. I think you've done a really good job of explaining this, Delaney. I appreciate you really fleshing this out. So sticking in line with the theme of this episode, you don't know how wrong you are. Let's go into some of the other biases. Let's talk about overfitting. What is overfitting? And maybe let's talk about some best practices for how to avoid overfitting.
Sure. So again, if people want to like muck around with this more, there's a full lecture in the Quantopian lecture series on overfitting. And again, you can get to the lecture series if you go to quantopian.com/learn or directly if you want it by quantopian.com/lectures. And overfitting at its core, I would say, is actually kind of one of the biggest problems that people deal with in finance. And what it is it's similar to multiple comparisons bias. So like kind of try to keep the same kind of ideas floating around in your head if you can. But the idea is that if you look at some set of data, and again, you're making decisions. You're looking at some set of data. Some of that data is going to be, if it's the right data set, some of that data is going to be like useful data. You can make decisions off of it. It's related to the thing that you're trying to predict. And then some of that data is just going to be random noise, and as an example of this, let's say that you're trying to model temperature, and temperature in some neighborhood, and you have a data set, and the data set is the temperatures of all the surrounding neighborhoods, as measured by the thermometers in the surrounding neighborhoods. You just don't have a thermometer in this neighborhood. And then also the number of pop songs that were played on a local radio station that day. Like one of those is unrelated and it's just noise. It's pure noise. It's not related to the outcome in any way. And what overfitting is when you make a model that fits really, really well to the data set you have. In fact, so well that it's also fitting to that noise in addition to the real signal that relies underneath. And it's a little tricky to kind of get an exact sense of this without seeing an example. So again, for people who are familiar, I recommend just looking up overfitting, and there's a bajillion examples of it. Again, like I said, the lecture series has examples of it. But the idea is that, you construct a model which has 100% predictive accuracy over that historical data set you're looking at. And if it has 100% accuracy, it has to take into account, the noise that's coming from, your data not being perfect. And if it's able to take an imperfect data set and create and have a perfect prediction, then if you take that going forward, it's going to be too finely tuned in to all the little noise and little things that popped up, right? And so you could, as an example, if you're making a back test, right, what you could do is you could say, I have a back test, I have a trading strategy, and I want to be not vulnerable to another financial collapse like the one that happened in 2008. And so what I'll do, and this is actually where multiple comparisons bias can come in here, what I'll do is I'll look for signals that seemed to match with, the collapse happening in 2008. So what you do is you say, okay, well, in 2008, I noticed that, housing growth followed this pattern. I noticed that the LA Dodgers had won and lost in this pattern, and I noticed that the temperature in Sacramento followed this pattern. So my model for avoiding the next financial crisis is going to take those three variables and look and say, if at any point these three variables line up with what happened in 2008, I'm going to move to cash, right? And that's a particularly ludicrous example, but when you start saying, okay, well, I'm going to look at the movements of Apple in 2008. I'm going to look at, JP Morgan's stock price, which probably is related to 2008. Apple, maybe not as sure. And I'm going to look at the movements of, Pepsi Cola in 2008. Is that related? I mean, maybe, I don't know. What you can start doing is just looking for these incredibly specific patterns that have no bearing on what's going to happen in the future. And you've become overfit to this historical data. And it's amazing how easy it is to do that and how subtle it is to detect. And it's actually one of the biggest problems that we have to deal with at Quantopian every day, because we have to differentiate between algorithms who look really good historically because they're overfit and algorithms who look really good historically because they're going to keep performing well into the future.
So how do you differentiate between the two? Like, what are some of the things you do to get around this issue?
So really kind of like there's two main things you can do. And the first and foremost, and it's really like the gold standard for avoiding overfitting, is something known as out of sample testing. And again, now, we can go as deep into the weeds with this as we want. I don't want to necessarily kind of bore or scare people who haven't done much with the statistics in the past. But what the idea of out of sample testing is, you do is you develop your model and you do all of your model development and your strategy development on one data set, but you've saved some of the data. You haven't run out of data. You've taken some of the data and you just haven't looked at it at all. And I mean that, like, you haven't even explored it. You haven't poked around it. You've just cut it off. You've taken your Excel file. You've cut it off under a certain number of rows. You've taken that. You've put it into a safe. And then what you do is, once you're done your strategy testing, your strategy training, as you call it. We call it training and then testing. You've got you're training your strategy on the in sample data that you use, and then once you've done that, you say, okay, now I think it works really well on this data set, but I want to test whether it's just fit to noise in the data set, or whether these are like real patterns I found that will continue forward into the future. And so what you do then is you say, I run my model on the testing data set, which you haven't looked at all, and it hasn't been used in the construction of your model. And because it hasn't been used in the construction of your model cannot be, overfit to the random noise that occurs in the testing data set. And so its performance over the testing data set is usually far more indicative of the quality of your model than the performance over the training data set. But the problem is that you only have a finite number of tests, and rarely is just your model work on the first pass. So generally you'll have to save several out of sample testing segments from your data, or wait for new data to be collected as time goes by, or something like that.
Okay, so what's a good ratio to have of in-sample and out-of-sample data? Like if you have let's say 10 years worth of minutely data for the SPY, how would you segment that data into in and out of sample?
Sure. So, again, we're getting into things which are very well studied in statistics, and I may miss crucial papers, and if you're a statistician and I say something right now that's just completely wrong or completely misses a key paper, please angrily write to me, because I want to know, but not too angrily. How I would approach this is basically the following. This is where it kind of gets into more of an art than a science to an extent, but generally some people like doing 90-10 as a split. One thing you have to be careful about is that with market data, things change over time. That's known as non-stationarity, if things change over time. And so if you're developing a model on 2000 to 2009, and then you're saving 2009 to 2010 as your out of sample test, well, 2009 to 2010 may just have completely different behavioral characteristics than the 9 years prior. And so it may not be a great test of your model. That's just something to consider. And so doing things rather than splitting across time, sometimes it can be better to split across, say, tradable assets, and just take a bunch of your tradable assets and move them into your out of sample test period, out of sample test set. So that's one way to handle it. Again, in practice, there's lots of resources for this online. If you just look up out of sample testing, you can get there's lots of people who do things like cross validation. Some people do this thing called jackknifing. Some people do things like bootstrapping on limited data sets. Lots of different crazy things you can do. But at its core, the concept that I really want to get across is just this idea that, you need to take some of this data and not touch it until you're done developing your model. And the other thing that's dangerous is that, let's say that you are developing some model and you follow this procedure really well, and you develop the model, and then you save 10% of your data, and you go ahead and you test your model on the other 10% of your data, and it doesn't work, so you give up. Okay. You come back 2 months later, you have a new idea. So you develop your model in the first 9 years, and then you test it on the next year. And it doesn't work. Okay, you do this like 10 times, right? Well, now we're starting to get into multiple comparison bias territory, in which if you try enough ideas, one of them will get past the out of sample test purely based on random chance. You know, it's just there's some chance it gets through. So it's just important to realize that these biases kind of pervade in many different directions, and it's hard to account for all the different directions that they pervade. And you can pretty much never completely avoid these biases. You can just minimize the chance that you run into them.
Okay. I like how you brought up the point about, different sets of data.
Non-stationarity. Is that what you mean? Yeah.
Yeah. How there's different market conditions, so if you have a strategy that you've tested from 2009 to 2000 to 2009, and then you run it on 2010, might be very different market conditions in 2010. So it's not a fair test. I really liked that point that you brought up. Just moving on now to another type of bias, and that's survivability bias. Take us through that. What does this refer to, and what measures can a trader take to eliminate this?
So again, I'll just pick on that language point of eliminate, because basically just to drive this point home, you can't eliminate these biases. They are kind of things that are always there in some quantity, and your best bet is just to try to reduce that quantity as much as possible. With survivability bias is the notion that let's start with a simple example. Let's say that you have 1,000 coins, okay? And you flip all of those coins once. You go down in a row and you flip the first one, the second one, the third one, the fourth one, etc. And then when you've gotten through flipping them all, you step back and you say, okay, how many heads did I get? And well, the answer is that if they're fair coins, and your flip is a fair flip, you should get about 500 heads. Right? So you say, okay, I'm going to get rid of all the tails. Just knock them out of my set. Okay, now I have 500 coins left, and you go down and do everything again. You flip them all, and you get left with 250 heads. And you knock out all the tails, and you just repeat this process. Well, it turns out that there is a kind of a decay of how many heads you should expect after a certain number of flipping processes. And so survivability bias refers to the fact that if you look at one of these coins, and you say, oh, wow, this coin has gotten 10 heads in a row. Well, you might not be looking at all the coins that didn't get 10 heads in a row and are just never coming across your radar because of that. So let's take this analogy and let's put it into traders, right? Let's say that you start with a population of 1,000 traders, and they're all making trades. And let's say that they're all making random trades. There's literally no skill in this population of traders. Well, after 1 year, there's some chance that you were up or you were down. And let's say it's 50-50 because kind of these traders either place largely up bets or largely down bets with a lot of leverage. And so the traders that, got the market wrong, they're all going to have lost all their money and they're going to be out of the business. They're not going to be posting on the trading forums. There's not going to be any news articles written about them, and then you go for 2 years, you go for 3 years, you go for 4 years. Well, there's still going to be a few left. It's not going to be a ton, but there's still going to be a few left who just based on random chance have gotten it right every year and made tons of money. And generally, these are the people you hear about. These are the people, and again, I'm not saying that everybody you hear about is unskilled and just lucky. I'm saying that it's hard to distinguish. It's really hard to distinguish because you hear about someone and they say, this person has gotten 70% per year for the last 3 years. Well, what about all the people who didn't get 70% per year for the last 3 years and dropped out of the running and aren't on TV right now? So survivability bias is this kind of very pervasive notion in finance that whenever you're looking at performance results, it can be really hard to tell if they're based on luck or they're based on something real. And actually, out of sample testing is one way to try to get at that. You say, okay, well, I don't know if this is based on luck, so let's test it going forward for another, year and see, if this guy can make mostly right trades. That's one of the ways you can try to get at it.
Okay, excellent answer. And just moving on to the fourth bias, which I'd like to cover, and that's our data cleaning bias. What do we need to know about this one?
So, this is a fun one in finance, and other people may call it something other than data cleaning bias. That's just what I call it. So when you are using data to set up some kind of trading system, and I'm sure many of your users get data from many different places, right? Some of your users may just get kind of daily data that they scrape off of Yahoo. Some of your users may get, they purchase data from some data vendor, whatever, it comes from all over the place. And I think I might have just said user rather than listener, which just shows you how deeply dug into the startup culture I am here. So the idea is when you buy that data, oftentimes, in fact, I would say, I don't know, I don't have statistics on this, so I'll just say oftentimes, that data will have corrections baked into the data. And what I mean by this is, let's say that, your data provider comes out and they say, the price of Apple today is $1 trillion per share, and, you as a human say, I don't know about that one. But, an algorithm that's making decisions may say, oh my God, this is the greatest short opportunity of all time, right? And so this data says Apple is $1 trillion per share. And then they come out the next day and they say, the price of Apple today is $101 per share. And we have issued a correction for yesterday. The price yesterday was actually $100 per share, and someone put their finger on the zero key too many times or something, So that's a correction. And the data that you look at, most times that you get from data vendors, has had this pre-cleaning done to it. They've gone back and they've wiped out the cases in which they were wrong live. And so when you are testing a strategy on this data that you get from your data vendor, you will not have any of these bad things happen in the back test of your strategy. You won't be able to say, oh, how does my strategy do if my data vendor just gives me a completely wrong piece of information? Is it robust to that? And so you may have these inflated performance numbers based on your data that you're backtesting on being higher quality than the data that you're actually going to get in a live feed from the data vendor. This is kind of one of those catastrophic scenarios often where an algorithm could be vulnerable in some weird way to some weird extreme piece of data coming down the wire. And, you could make some really horrific trade and end up having to lose a lot of money. But this is just something that you will not notice necessarily unless the data that you're using has kind of a representative amount of dirt in it compared to what you'd get normally.
Okay. So why do these bad prices or these bad prints occur? What triggers that?
It can really be anything. I don't know if you've ever used a piece of software and had something weird happen, but just back that out to imagine that piece of software is producing data. It's really, they can come from anywhere because the stock exchanges are running a piece of software, and then oftentimes there'll be one data vendor that consumes it from the stock exchange that will then sell it to a second data vendor, which packages it up. And then maybe that second data vendor licenses it to a third data vendor, which sells it on a retail basis. So this data oftentimes will change hands and go through many different systems. And it's really difficult to track where in those systems, you might have weird bugs like this pop up, but they can be things that are as inane, like I said, to someone literally putting their finger on a button too many times, which I think that's happened in the past, to as subtle as just a rounding error in a computer software that was hard to catch, that caused the price to wrap around from 1 cent all the way up to infinity dollars or something. Like little things like that can happen.
Right. Okay. And so how does a quant deal with, misprints or bad data, unclean data in a live environment?
So there's a few different kind of main ways to deal with it, I think. One way is basically kind of ignoring outliers. And this is a common tactic in statistics, which is just to predefine before you've looked at your data, kind of say, there's a threshold beyond which I think data is probably just like noise or something wrong with the system, and set those points and maybe have those points change as the data that you come in change. So a common thing would be to say, maybe to make it so that if the data is more than 3 standard deviations away from the current mean over the last month, then just don't look at it, or don't pretend it doesn't exist. So that's one way. And that's known as getting rid of outliers. And then there's another way, which is called Windsorizing, which is similar, except that instead of getting rid of outliers, you just set them to be the maximum threshold that you could, feasibly observe. So if you get a price for Apple and it's $1 trillion per share, and the standard deviation of the price of Apple over the last month has been $10 a share, and the mean has been $100 a share, then you say, okay, well, mean of 100 plus 3 times 10, which is the standard deviation, that's $130. So, I don't know what's going on here, but I'm just going to say this price is $130, and so you limit the damage to your system in that way. And a third and more structural way that quants will deal with this, I think, is really the most powerful, which is you say good quants are really good at admitting when they don't know stuff. And that's actually one of the things that kind of defines and kind of can set quants apart, is that they're really good at admitting when they are wrong and uncertain and don't know stuff. And again, that gets back to this core of statistics, which is quantifying uncertainty. And if you're really good at kind of saying, hey, you know what? I don't really think that, the chance that one stock is going to have a misprint is too high for me. So what I'm going to do is I'm just going to invest in so many assets that the chance that, enough of them have misprints at the same time to really damage my portfolio is very low. So this idea of accepting that bad things can happen and then adjusting the structure of your portfolio or strategy based on that acceptance is I think very common in quantitative workflows, and gets at, again, like I said, one of the ways in which quants might think differently from more traditional or discretionary traders.
Okay, another really great answer. I like this point. All right, Delaney, so let's shift gears here a little bit. Talk to us about quants. When did they come to be? What's the history there? Like, when did quantitative trading actually become a thing?
So, I'm not an expert on the timelines of how things started happening, but my general understanding is that kind of in the 1950 to 2000 window, and really when computers started being available, is when quants started popping up. And the idea was, well, you're sitting there and you have access to all this data, and why would you make kind of by hand decisions on this data when you could gain a ton of information based on looking at, summary statistics, trends, all of the stuff that, statisticians look at in their day-to-day work. So just as computers proliferated, it became more and more available. And as more and more of this data became quickly available, more and more, quants started being, popping up on Wall Street, and assets under management has been, kind of slowly trickling out of from, more traditional traders towards quants. And whereas quantitative investments, like purely algorithmic trading, still makes up a smaller percentage of assets under management. What's interesting is that so many firms incorporate some level of quantitative analysis. So it might not be that everything is controlled by an algorithm, but it might be that they have traders whose trades go to a risk system, which is quantitative. It might be that they have some analyst who uses some quantitative measures of some investment's quality before they go and pitch it to the board. Or, there's many different ways that you can incorporate quantitative analysis into your strategies. It's not just everything being completely algorithmically driven. And the other thing is that I believe the majority of trading volume right now is driven by quant strategies, algorithmic strategies. So one thing that's interesting is whereas, a smaller percentage of AUM is quantitatively managed, quant strategies tend to trade more. And so because they're trading more, they're actually a higher percentage of market volume. I believe, I could be wrong on that. I don't actually have the statistics in front of me. And so what's interesting is that nowadays, if you as like an individual go to place a trade, you're no longer really competing against people like you, because that trade is going to be matched against, I think probably most likely, a trade made by some kind of algorithm, whether it's an execution algorithm or a market maker algorithm or whatever it is. And so to an extent, when you're trying to enter into a position, you don't just have to worry about other traders anymore. You have to worry about, is there an algorithm that knows something that I don't? And that's why it's selling me this stock.
So this is probably a good point to ask, like, how have quants evolved since first sort of coming onto the scene? Like, are there trends evolving of current new ways of how quants are trading and looking to gain an edge?
So a lot of this stuff is really hard to know because of all the secrecy in finance. And, it's really hard to know exactly what people are doing inside the firms. And you can kind of try to reverse engineer it based on what departments they're hiring from and all that. But in general, I think that quants haven't changed a whole ton since they got started. And part of that is because, a lot of places actually didn't trust, they just didn't think quants were as valuable as they were. And so a lot of I think quant shops got started as quant shops. It wasn't like quants went to work for a large institution all the time. So, one of the things that has always separated quant shops is a lot of these people are much more, Silicon Valley, not Silicon Valley, but just laid back in their culture. Quants much more often tend to be closer to scientists than they are to, more of the suit wearing types you'd see on a traditional, trading floor or bank. And, it's just kind of an interesting little, different community that exists on Wall Street. And part of that is because a lot of them are hired from academia. A lot of quant shops, now and always have hired from physics and math departments. They hire from computer science departments because these are the people who are used to thinking about the world as kind of a thing that you can model and a stream of data that you can work with. So I don't necessarily think that quants have changed too much. I think that what they work on has changed. But I don't know if necessarily the roles have changed a tremendous amount over time.
Okay, sure. And I know one of the interesting points we were discussing before we hit record were some of the exotic data sets that are being used by quants today. Do you want to tell us about some of these data sets, some of the more obscure ones, and how they're actually being used?
Yeah, this is I actually have a lot of fun with these because it's just so sci-fi. When you get into some of these things and start actually being oh my goodness, they're actually doing that. So let me tell you one of my favorite examples of something that quants came up with to try to get an edge on the market. And one of my favorite examples is the following. So computer vision is actually pretty good now. And what I mean by computer vision is the ability of a computer to look at an image and tell you interesting stuff about the image. And one of the things that's actually kind of a very well-solved problem, because many different parties have been working on it, is identifying cars. And, car companies have worked on it. DARPA, which is the U.S. Robotics and Computer Science Defense Department, has worked on it. Now, of course, like Tesla and anybody else who's developing self-driving cars has worked on identifying cars. So there's all sorts of freely available scientific research on like how to get your computer to identify whether or not something in an image is a car. And so what some quants did is they went in and they said, oh, also, we have Google Maps now, right? We have satellites, and I don't think they use Google Maps, but they have satellites that get satellite imagery. And there's many companies which will sell you imagery from their satellites, kind of live imagery they get, or maybe they'll take 1 or 2 pictures a day, or even more frequently, depending on how the satellite orbits and everything. And so what these firms did is they said, okay, we're going to go in, we're going to look at the satellite imagery, and we're going to count the number of cars in parking lots outside of retail locations. And by counting the number of cars in parking lots outside of retail locations, you can actually look for when there's going to be changes in earnings and more accurately predict sales figures for these retail chains. You can look for downward or upward trends. You can look for shocks. All these things, that basically anything that doesn't match what you'd expect, you can say, in what direction does it not match what I expect? And therefore, I expect a positive or negative surprise when they actually release their figures next quarter. So what they did is they just did that. They said, we're going to count the cars. We're going to say if we expect a positive or negative surprise, and we're going to enter into positions based on that positive or negative expectation. And I just think that's a pretty futuristic and crazy way of getting at this information.
Yeah, satellite imagery is super crazy. I recently interviewed Michael Hallsmore from QuantStart, who I'm sure you're familiar with, and he also spoke about that. It just totally blew my mind. It's it's just so out there. I mean, while these sorts of data sets, like, as the example here, satellite imagery, it sounds very sexy, it's very edgy. Have these types of exotic data sets actually shown any sign of producing significantly greater returns than more traditional data? I mean, I know it sort of comes down to how you actually use it, but, broadly speaking, are you able to shine any light on that?
So one thing that I will say is, like, my opinions here are kind of, again, it's hard. I don't have this data in front of me, and I haven't done an analysis on this particular data set. So for like any particular data set, I don't know, when it was able to produce better returns, if it was able to produce better returns, how it was able to produce better returns. But my understanding is that basically these types of techniques, and another type of technique, which I'll talk about in a minute, but these types of kind of getting at these exotic data, were able to, basically be incredibly valuable, to the point that my understanding is that the cars in parking lot thing is actually like washed out now because everybody started doing it. So it's no longer a novel piece of information. It's just like kind of fully incorporated. But again, I'm not sure. I believe that's the case. And I was actually recently at a conference in Hong Kong put on by Macquarie Bank, which is, I'm sure you're familiar with, coming from Australia. At that conference, they had, one of their presenters was Terabella, which is a satellite imagery startup, which was recently acquired by Google. And Terabella was showing some of the new imagery techniques that they had. And not only can they create videos, satellite videos of like planes flying over the land, which is more for fun, I think, than for quantitative techniques, but they were able to do things like, what you can do is for every GPS location and time of year, you know exactly what angle the sunlight is going to be hitting the ground, right? And you can just kind of compute that, and you can say, okay, well, I know what angle the sunlight's coming from. So what you can do is you can look at the tops of oil tanks. This is just one example of like what they can do. You can look at the tops of oil tanks and say, I compute the size of the shadow on the top of the oil tank. And something that not everybody knows is that actually when you drive past these big oil tanks, the top actually raises or lowers depending on the amount of oil that's in the tank. And that's just so that there's just not this huge amount of air in there. Probably one of the reasons is to prevent a fire risk. But the top raises or lowers depending on how much oil is in the tank. And so what you can do is you can actually compute for oil refineries and oil storage locations how much oil is in the tanks. And what they were showing is they can do things like look at Iran and look at the refineries in Iran and actually show like where they're moving their oil around to, and look at the refineries in the Middle East and show how the oil is being moved around, and basically get the jump on big announcements of like, cuts to production or increases to production, or whether a company says they have more or less than they actually do. They know that because they can actually just track where the oil is being stored. And like, as a result, I think that people have actually started putting up like tents over their oil drums so that these satellites can't, the Iranian government doesn't want the US knowing where they're moving their oil to. So that struck me as another example of like something that you can do with this data, and a kind of just a new piece of information you can learn, which was just been completely impossible to hold, 5 years ago.
Yeah. I mean, it's just so crazy to think that people are actually doing this. I mean, it's just wild to think about. But anyway, Delaney, let's leave it at that for now. So like I mentioned earlier, we're going to be doing another 4 episodes following this one, plus a Q&A. Would you like to give just maybe a brief overview for some of the upcoming topics we'll be discussing?
Yeah, so I think the next 4 episodes are really designed to try to get into some of the major components of how a quant actually works in their day-to-day. And I think the purpose of today, and I felt that we actually were able to hit a lot of these points, is just kind of give people a sense of what some of the differences are between kind of a more traditional trader and a quant, and what quants do differently, and how quants think, and what quants worry about. And now for the next 4 episodes, we'll try to dive into specific parts of their workflow a little more. So something we'll talk about is what's known as alpha factors. And alpha factors is the idea of by valuing everything in the tradable universe, can I produce a ranking of things based on their future values that produces a trading strategy which has alpha? And if you don't understand what that means, unfortunately, there's not really a greater way to explain it without really getting into it. So you'll have to wait until that episode. And then we'll have an episode on how, well, in reality, quants really don't trust any individual alpha factor to work well on its own. So they actually will end up combining alpha factors together and combining different methods of predicting stock movements together to try to get a better picture of how the market's going to move as a whole, and therefore be able to, make better trades. Episode 4, we'll talk about, okay, well, let's say now you have this combined alpha factor that you actually think works pretty well. Well, the next step is actually taking its output and converting it to trades on the market. And we get into this new game there of risk optimization and portfolio optimization, and the idea of how do you decide whether or not to enter into a new portfolio. And it turns out that quants have all sorts of definitions of portfolio risk, and quantitative hedge funds will basically, every trade they make, before they make it, will go through this extensive optimization and risk calculation, which just says, is there a better way to make the trade? And if we make this trade, will we be violating any of our risk tolerances? And if the latter is true, the trade is not made. So every single trade will kind of enter through one of these checks at a quantitative firm often, and these things are done in the course of like less than a second. Oftentimes way faster than that, obviously, if you're doing something higher frequency. And then episode 5 is, machine learning is a really popular concept. It's a really popular topic all over the place, not just in finance. A lot of people constantly ask us, hey, you're going to have lectures on machine learning? Are you going to do this with machine learning? You're going to support machine learning on the platform? And machine learning is another one of those things where it's a really, really powerful technique, but it's also really easy to shoot yourself in the foot with machine learning. So we're going to talk about that on that episode. And then episode 6, as you mentioned, I think we're just going to have a chance for us to iron out some of the kinks that maybe came up and things I didn't explain very well or others didn't explain very well. And here it depends on people's schedules, but we'll try to bring on not just myself, but we'll try to bring on Jonathan Larkin, who's the Chief Investment Officer at Quantopian. He's worked at some really large financial institutions. We'll try to bring on Jess Stouth, who's our VP of Quant Strategy, and she's actually in charge of selecting which strategies are or are not included in the portfolios that we develop. And Thomas Wiecki, who's our in-house director of data science. And, he's a PhD in neuroscience from Brown University and works a lot on the strategy selection side. And also Max Marginot, who's and I completely mispronounced his name there, so I apologize to him. But he is someone we just hired actually to work on the lectures. And Max's background is in statistics, and he can explain some of this stuff really well. So we'll try to bring those people on as well to answer some of these questions more specifically.
Yeah, it's going to be good. It's going to be good. So where can listeners go in the meantime to get these resources? Maybe if you just want to give that URL you mentioned earlier again.
Yeah, so for now, let's go ahead and say the best way to get these resources is going to be quantopian.com/learn, LEARN. And that's going to bring you to a page where you can, get started with tutorials, or you can kind of try to dive into these lecture concepts. And I think I mentioned some specific lectures during today's podcast that you can dive into that were related to the concepts we discussed. And so you can find those in the lectures page. You can go there directly, quantopian.com/lectures.
All right, Delaney. Well, this has been a lot of fun, man. I really look forward to picking up from where we leave off right now on the next episode. Thanks very much.
Yeah, absolutely. It's been a lot of fun. I appreciate the chance to talk to you and indirectly to many more people about this stuff.
Cool. And guys, thanks very much for listening. We'll catch you on the next episode.